Live from Singapore, this is Inside with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Trump weighs heavily on the markets. Bitcoin hits $81,000 on hopes of looser regulation. Meanwhile, China's stocks look shaky as Beijing prefers to keep some of its fiscal powder dry to face the U.S. tariff threat. We have some great guests to weigh in on the top Trump trades. Vantage Asset Management CIO and founding partner Nick Ferres is joining in a few minutes. Later, we have Fang, the president of crypto exchange OKX, and earnings from some of India's top retail names show that consumers are tightening their belts. We get a perspective from a global brand with L'Oreal's regional head. Well, Asian shares slip after China's planned debt swap program looked insufficient to some investors, and data showed persistent deflationary pressures. Beijing stopped short of unleashing new fiscal stimulus, probably keeping some powder dry to fend off any risk from Trump's threatened tariffs. And Trump is definitely ruling market sentiment, with Bitcoin's value surging past $81,000, which is a new high. The rally is being fueled by hopes that he will go easier on regulation on the prospect of a Congress stacked with pro-crypto lawmakers. Meanwhile, bond futures are looking rough, with fears that higher tariffs will be inflationary and force the Fed to reassess rates. Of course, some say yields heading to 5. My guest here in the studio bet big on the Trump victory. Nick Ferres, founder, partner, and CIO of Vantage Asset Management. Welcome to Inside. And pleasure. You saw this coming. You positioned for it. What are you doing now?
If you ask me to describe what I do in one line, it's to take on the emotional sources of volatility in markets or the emotional overreaction. And I think, you know, in the first episode in 2016, certainly it was a lot more emotional. It's been emotional in a different way this time around. And I think, as you rightly pointed out, or as we were talking about offline before, quite a bit's been priced in ahead of the election this time around. And I think, one of your colleagues had a great interview with Stan Druckenmiller a couple of weeks ago, and he mentioned that the internals of the stock market were suggesting that this was likely to happen early on. And I think the rise in Treasury yields, the strength of the US dollar, Bitcoin as well, was a tell on the day. In terms of our positioning and the way we expressed it was via Japanese equities. We've got 15, now 20% of our portfolio in Japanese equities. We're also long the US dollar against the Japanese yen, which is also a beneficiary and has been performing well.
Are you adding to your positions? I mean, how much upside do you see from here?
We did. So we added to 5% to Japan last Friday. If you look at our basket of Japanese equities, and we do this both from a bottom-up perspective, and we've got a quality bias within our exposure. It trades on 9 times earnings. It's massively net cash on balance sheet. Japan as a market has got the highest beta or sensitivity of EPS to global industrial production of any market globally apart from Korea. So it's certainly a beneficiary if Trump improves the global growth outlook and improves via regulation as well. Japan is probably also a more friendly trading partner of the United States.
Is it time to be a bit more cautious when it comes to these Trump trades? Take a look at yields. Some say headed to 5%. At some point, high yields will hurt stocks.
Absolutely. I think one of our concerns, and why we don't have a large net long exposure overall, is that the equity risk premium, or the difference between the earnings yield on the US stock market and the 10-year Treasury yield, is actually almost zero, or it's around zero. So you're not getting a lot of risk compensation in the global risk proxy, the S&P 500, which is still very important for driving overall global risk. And certainly perhaps markets are underestimating the impact of the higher cost of capital. So that's certainly a risk. But also, we would argue that perhaps some of the way prices responded to news is, and the way it plays out over time is not necessarily obvious. perhaps the fiscal impulse won't be as aggressive. Perhaps deregulation is actually more positive. Perhaps actually he borrows Elon Musk's improvement in improvement in government efficiency as a way of sort of reducing the negative fiscal impact of excess government spending.
Right. So how do you trade that? If you think deregulation may be beneficial, I mean, what's the trade for that? How would you position for that?
In terms of, I mean, the obvious one in the US stock market, which we'd done previously, as I said, we now focus on Asia Pacific in our markets, but when I was working for Prudential at the time, we focused on the XLF US financials, and that certainly performed well. But it performed very well in the lead up to this. US financials ETF, the XLF, is up about 46%. Over the last year, so it's certainly priced in a lot of good news already. It's up, 6% on the day of the election, so it's performing well. I think where it's probably more interesting in this part of the world, as I said, our Japanese equity exposure is only on 9 times earnings. Perhaps the pessimism is too great, and we can come on to this in terms of Chinese equity, which is only trading on 10 times earnings. So perhaps it's actually interesting to look elsewhere compared to where we did last time.
Before we look at opportunities in Asia and in China, as you pile into those Trump trades, what signs are you looking out for? Because if you take a look at 2016, at the end of Trump's presidency, we actually saw Trump trades underperforming. So what signs are you looking out for to decide that it is time to let go of those Trump trades?
Yeah. From memory, I think on the 6th of December there was a fantastic Economist cover, which was a contrarian indicator, and it was the cover was the mighty dollar, and that was roughly the top in the US dollar, and that sort of trade at that point in time. So perhaps we get into December, early January, and a fair bit gets priced in. So that would be a contrarian signal for us. I think from a technical perspective, long positioning especially in US equities, is pretty stretched already. There are some signs of sort of momentum divergences. So, perhaps into December, early January is when you might start to, at least from a net exposure perspective, start to trim risk.
You talked about how there are opportunities in Asia. You piled into Japan. Let's talk about China. We had disappointment on the back of the lack of stimulus, especially to housing, consumption. But, when it comes to valuations, I mean, 10 times is pretty cheap. If you take a longer-term perspective, surely there are opportunities to pile into Chinese stocks.
Yeah, absolutely. I think if you extend your time horizon, it is more interesting. I mean, Asia overall and emerging markets are trading on a price-to-book relative basis back where they were in 97, 98 versus US equities. Now, the outperformance of US equities over the last 14 years has definitely been warranted by relative earnings growth. So it has been fundamentally driven. But you're at such an extreme valuation point now, in a relative sense, that perhaps the better returns, looking forward, are actually in this part of the world, and especially in China, where you've got revulsion. You've had a bear market for 3.5 years now. It's already very, very pessimistic. And I think at least from a policy perspective, there is a recognition now that the Chinese authorities have at least shifted more towards focusing on fiscal expansion and fiscal reform, which is important. I think although the markets were disappointed with the focus on the debt swap, that is important in terms of shifting those liabilities from the weaker balance sheets in the local government sector to the stronger central government balance sheet.
So we've seen that inflection point in the Chinese market? Time to consider? That's
our sense, yes. And actually, it's interesting how price responded to news today. Our sense was that probably, it's plausible that markets could have been down a lot more in terms of that disappointment. So perhaps there's, again, signs that the market didn't fall further on bad news.
But are you not concerned that it is consumption that remains lackluster, and it's consumption that's needed to turn around the Chinese economy?
I think that's absolutely right, but there has been signs in terms of the way the policy announcements have or indicated where they're pivoting, that there is going to be a pivot more towards consumption. I think the point of your question there is that China doesn't need more investment. It's already a very high share of investment share of GDP, and the household savings ratio in China is already very, very high. So there does need to be a pivot towards consumption, and I think that's why where we've focused our attention in terms of the Chinese equity market has more been on the big platform stocks like Alibaba, Tencent, Baidu, JD.com, and Meituan. And if we take a basket of that equity, it's trading on somewhere between 9 and 11 times earnings with net cash and 30% EPS growth. I mean, a company like Tencent still has a gross margin of around 50%. It's still a very profitable company despite the impact of regulation.
So those tech stocks are looking pretty attractive. I mean,
in a medium term, yes.
Singles Day today, right?
Yes.
I mean, you got to imagine that the data out of Singles Day would be quite indicative of how consumption is doing. How important is that to you in your decision making?
Not in a medium-term sense. It'd certainly be interesting to watch. I think, as I said, that those big platform names are inexpensive. They're already net cash and they've got decent growth prospects. So on an extended time horizon, they are very, very attractive.
And renewables, which China is big on, might the renewable players be attractive to you as well?
I think that's a much more challenging sector from a debt and leverage point of view. Perhaps that's perhaps a negative. Perhaps a switch back to focus on fossil fuels by the new administration. That'll be interesting next year. So that may be a more challenged sector.
The risk from tariffs from Trump, I mean, how are you assessing that? You said initially that perhaps it'd be used as a leverage, as a negotiating tool. So you're not anticipating that 60% tariffs on Chinese products? Is that a fair assumption?
I think the consensus belief is a 60% increase in tariffs across the board for China and roughly 10% globally. So if that is already the consensus, then I think it's widely appreciated. That's approximately what Morgan Stanley economists would argue, I think, for example. So if that's the consensus belief, I think it is relatively well priced and appreciated. It would roughly, again, Morgan Stanley would estimate that would take about a bit more than a percentage point off growth. It would add about 0.9% to core inflation. So it would be a net negative, but it does depend on how the length of time. So perhaps if it is only used as a negotiating tool, and the Chinese are pragmatic, and perhaps they can negotiate with Trump. He's a better or more well-known quantity this time around. So perhaps it could play out differently.
The narrative we're hearing right now is that traders are taking money out of India to put it into China, but we're also hearing the hedge funds are pulling money out of China. On the ground, on balance, what are you seeing?
Certainly on that disappointment, I think China is already well under-owned. And I've over the last 2 years, I've been asked a number of times, can you do your mandate or do your fund ex-China? And I think as a contrarian investor, I think that's kind of interesting. If you
we're seeing that increasingly, right? How traders are trading emerging markets ex-China.
Exactly, and I think to be fair, there's the performance of India has been strong again for fundamental reasons. The compound earnings growth in India over the last 10 to 20 years has been around 9%. It's only been around 2% for the rest of Asia, MSCI Asia ex-Japan. So certainly India, again, is the outperformance has been warranted. But if you do EM ex-China, you're certainly overweight India. And you're paying pretty punchy valuations for that. It's not a negative view on India, by the way. It's just that the price you pay matters for your future return, and you're paying some pretty euphoric valuations in India.
So India versus China right now, it's more attractive to be putting your money in China versus India.
As a contrarian, yes.
How about the rest of Asia, especially emerging markets? We've seen how emerging markets have been pretty lackluster since 2010, and some have been saying that story is changing, but we're still waiting for that to happen.
Yeah, we've got a couple of key positions for us. The other big position, apart from Japan, which, as I mentioned, we took from 15% up to 20% of the portfolio, the other big position is Vietnam. And that's it's still a frontier market. We've expressed Vietnam. It's important how you buy Vietnam. And we bought Vietnam through an active fund listed in London called Vietnam Holdings. And the ticker is VNH-LN. And their performance has been exceptional. They've beaten the local index. Forgive me, I'm going to get the figure wrong, but by about 85% over the last 3 years, I think. So they've materially outperformed. They've had a greater focus on tech and consumer, and certainly Vietnam has been a beneficiary. I think one of your colleagues pointed out earlier this morning that that Vietnam wasn't an underperformer, on the day of the election. And I think that's because it has been a beneficiary of the shift away from China.
Speaking of outperformance, we're suddenly seeing that in the crypto space, Bitcoin in particular surging past 81,000. I'm just wondering, what would it take for institutional investors to buy into that? I mean, we talk about, regulatory clarity. We're increasingly getting there.
We don't have any direct exposure to Bitcoin in our funds. That's a really good question. I think as a fundamental investor, our observation is that it's a liquidity beneficiary. It's if you look at it most of the time, not all the time, but most of the time it's been correlated to the NASDAQ. I can value the NASDAQ, so I can perhaps have a better fundamental sense of what it's worth. As I mentioned, it's not a negative view on the asset class, but if we continue to see a phase of US dollar strength as a result of a Trump victory and perhaps a higher cost of capital or a higher path of interest rates.
But at some point, can you afford not to be chasing that rally if it continues its way up? And some people are now suggesting $100,000.
Well, I think we can still get good returns in traditional markets to offset that, but certainly it's performed well. It's, as I said, it's not a negative view on the asset class. It's just that our sense is that it's a more challenging asset class to value.
All right, Nick, we'll leave it there. Nick Ferres, founding partner and CIO at Vantage Point Asset. Thank you so much for your time today. Well, still to come, Bitcoin tops 81,000 for the first time as it becomes a totem for the new Trump era. We'll get more insights from OKX President Hong Fang later this hour. Keep it here with us. This is Bloomberg. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. Welcome back. China's new support measures disappointed investors hoping for more powerful fiscal stimulus. And data over the weekend showed anemic consumer inflation. Meanwhile, the country's largest shopping event is underway, and traditionally Singles' Day is an indicator of consumers' spending habits. Amid a soft retail landscape, platforms are pulling out all the stops to boost sales. Bloomberg's shopper, Emma Hong, joins me now. It is going to be, well, a must-watch.
Yeah, I think it's absolutely key to watch this time around. I mean, you look at how it's been a really challenging backdrop, as you know, for these e-commerce names the past couple of years. Some of the trends that we're seeing that are interesting to note is that so far the data this year actually shows us that online channels are actually accounting for more of the sales gains compared to the brick and mortar so far this year. So, that will really allow us to glean a bit more from consumer shopping habits. And as you know, this is an event that has kind of morphed from 2008, right, when it was started off by Alibaba into this weeks-long extravaganza. And now we're seeing the way it is this big event for these e-commerce names names to really get as much as they can in terms of sales each year. So this time around, from the platforms, what we're seeing is how they're pulling out all the stops, doing all they can, as you say, offering cheaper products via steep discounts, or even when you look at the access to refunds or delivery times, that is all improving. And also, we see how they're pushing out these more online exclusive products. But perhaps more notably or importantly, this time around, they're just going for longer events as well. So you have on average, some of the platforms, I think they're adding like a week or two to the event, and you have ByteDance's Douyin adding 12 days to the event to 34 days. So it's more than a month-long affair at this point.
For consumers like us, we love discounted products, yes? But for them, in terms of margins, how is this going to play out? So, what are we anticipating in terms of sales, and how will that translate to, in the end, to their bottom line?
Yeah, I mean, we're already seeing their pressures on their margins, right? That's something that's been apparent the past couple of quarters. But there is some maybe cause for optimism that all these promotional efforts, are going to kind of draw out these shoppers. You look at how Bloomberg Intelligence is already highlighting that the gross merchandise values, they see a bit of space. It looks quite promising in the sense that this year, so far, it's already 3/4 of the values of last year during that event. So it looks like, there is some room for that catch up, and things are looking okay at the moment. Perhaps more important to watch, and to your point about competition, is going into next year and how this price rivalry can potentially heat up. I mean, we see that the stimulus that's been offered so far, Chinese authorities are biding their time. So it becomes more important to watch how that actually plays out into the consumer backdrop.
And how that plays out into the earnings. We have the likes of Alibaba, JD.com, outwin numbers. What are we going to see?
We are already seeing that negative reaction in the Chinese tech names' stock prices today, right? And I think despite this, and you might not think it, but there also similarly seems to be a bit of cause for optimism. You have the likes of UOB Kay Hian saying that, investors seems to be looking more optimistic towards some of these names as they see a more favorable regulatory backdrop. So these are kind of the factors that we're watching, but something that's also really interesting to watch among the internet names is how they seem to be leaning into competition, because some of these platforms, they're actually, having the delivery services and the payment services of their rivals on their own platform. So it's going to be interesting to see how this kind of plays out into their earnings scorecards in the next few quarters.
We talk about rivalry. It's not just domestic players. It's also international players, brands like Lululemon, right? I mean, it's doing really, really well in the Chinese market. I mean, give us a sense of what's gone right for this brand.
This one is a bit of a head scratcher, Has, because it's a Canadian yoga wear, brand, and somehow, even when you have these other big retail giants, LVMH, Starbucks, they're really struggling on the mainland, Lululemon is doing well. It's managed to, the sales are topping $1 billion for the first time. China is set to become its second biggest market behind the US when its own North American market is actually slowing. And not only that, it's actually managing to sell products at a more expensive price point, about 20% more expensive than some of its US products.
$150 yoga pants.
$150 yoga pants, and I think $600 for, apparel. A bit out of reach for me, I think. But I mean, I think one analysts put it really well in that this speaks to deeper shifts in the consumer picture in China, in that they're pulling away from ostentatious, wealthy shows of wealth, and they are actually at this point, more focused on perhaps some of these like wellness products. So this speaks to the broader trends as well in China.
Well, something to be learned from Lululemon strategy. Avril Hong, before we go, let's take a look at how the Chinese markets are doing under some pressure there on the back of disappointment when it comes to that lack of stimulus. CSI 300 index currently down 0.3%. Now, still to come, Bitcoin tops 81,000 for the first time as it becomes a new totem. Welcome back. You're watching Insight. We're tracking the rally in Bitcoin with the world's largest crypto topping $81,000 for the first time after Donald Trump's election victory. Bitcoin has now almost doubled in value this year as Trump embraced digital assets during his campaign. We'll talk about a strategic Bitcoin stockpile and looser regulations. The industry also flexed its muscles during the campaign, spending over $100 million backing crypto-friendly candidates. Let's go a little deeper on Bitcoin's record-breaking rally. Joining me is Fang, president of OKX. Hong, good to have you with us. I mean, is this a reasonable rally? I mean, how much more upside is there to it?
So it's funny, about 4 years ago, I wrote a piece on why Bitcoin can reach 100,000. And I think in 2025, there may be a chance that we actually see that prediction coming across. But putting that aside, I do think that Bitcoin's value has always been holding true. The reason we are seeing it going up is exactly a reflection of markets' reaction to Trump administration or the anticipation of Trump administration being pro crypto, pro Bitcoin, and also pro economy.
Right. So they say huge things are coming. What exactly are we looking out for? What would be a game changer in terms of regulation, easing a regulation? What would prompt that rally to go higher?
I think there are actually two sides. One is really market expectation about how the Trump administration's policy will affect the macro economy in general, general policies around tax cutting, general policies around healthcare spending, around their external policy, and the impact on labor market. That's one side. I think generally right now, at least, the market is very optimistic about what the new administration will do and how it will actually help support the market. I think the other side is about what the market expecting about the administration's policy toward crypto, right? In general, like clearer policy, clearer regulation, whether there will be actually a federal regulator instead of in current state, it's very much state-by-state approach. Is SEC or CFTC going to take the realm? How long will the industry see actually certainty? And that actually have a huge impact on how the banking industry, particularly the tier one banks, their appetite in accepting crypto business and providing on-ramp to crypto platforms, which obviously have a downstream impact on crypto price in general.
What do you think would prompt that turnaround when it comes to institutional investors buying into the crypto story?
You know what? Institutional investors have always been interested in crypto, particularly in the last, I think, a year and a half. That interest has been pretty clear. They may not be talking about it very openly, every one of them, but the reality is from our side, on the exchange side, we have seen consistent interest from institutional customers. We also have previously done a research with institutional customers, and it shows that actually 70% of all institutional customers in a traditional financial industry actually have a plan to invest in Bitcoin in the coming 3 years. So I would say that interest is always there. It's really whether they are actually talking about it, how much they're talking about it. And as you know, institutional customers are very sophisticated customers, investors, and they don't they tend to be quiet as they build their position. But on the other hand, I do think that the upcoming regulation clarity or anticipated regulation clarity will also draw more institutional interest into this, particularly when it comes to corporate and also potentially national reserve currency. I think that can be a very interesting additional tailwind that the market right now is not pricing in. But as we see more clarity in policy and also in the shakeup of administration, I think we'll see more coming into the market.
The issue has always been legitimacy of cryptocurrencies, and we've seen some of the clarity coming through already with regards to ETFs, for example. I mean, yet the institutional investors did not bite. What is it? What would it take? What exactly would it take for institutional investors to buy into this story?
Institutional investors are buying. Not only the corporate, some of the companies are buying using their treasury money, but all the major institutional customers are actually building their position, including BlackRock. So what we're actually seeing across the board, regardless of which jurisdiction they came from, is that they're actually looking into the Bitcoin, either buying directly or buying through Bitcoin ETF. But I think we will probably see more of such news coming into the market in 2025.
The question really, Hong, is whether or not you can hold Bitcoin for the long term. We've seen this rally before. I mean, yes, it's surging past 81,000 for the first time ever, but we've seen a massive rally followed by a massive drop. Why is this time different? Why should it be different? I mean, we know that Trump is
also
not
going to be different. It's not going to be different. Volatility is always going to be there. But if you zoom out, in addition to volatility, you also see upward trend very steadily in a 4-year cycle. And I personally believe, and I think a lot of the long-term holders believe, that volatility is the price that you have to pay. You have to be able to understand and actually endure volatility over a long period of time to be able to actually really win in this asset. And if you really zoom out, say, 4 years, 5 years, 6 years, Bitcoin outperforms every other asset class in the market. So it's not going to be different this time. It's still going to be volatile. So everyone who is actually looking at the market and thinking whether they want to jump in, if they are a new investor or existing investor, adding to their position, they need to be thinking about volatility. They need to be careful and leave the room for error. But this is an asset for long-term holding. That's not going to change.
Bitcoin strategic reserve, that's an idea that, Trump has thrown out there. How realistic is that? What's the possibility of that actually happening?
I think there is a good chance. There are actually quite a few pro-Bitcoin senators and congressmen that are winning their seats. And one of them, Senator Loomis, has been very vocal about pro-Bitcoin and about establishing Bitcoin reserve at the federal level. And as a matter of fact, if you look at United States, at several states already, at the state level, Bitcoin has already become a reserve currency at the state level. So the next question is, when can it become a national reserve currency? I think that conversation is ongoing, and there's a chance that we're seeing more of that coming in 2024.
And what ripple effects might that have for the rest of the world?
Well, there have been a few countries, obviously smaller ones, who have been taking Bitcoin as part of their reserve currency strategy. And I think if the biggest country in the world is using Bitcoin as part of a reserve currency strategy, that will basically start a domino effect globally, which can have very interesting implication on Bitcoin price.
Also, in terms of regulation that is expected in the U.S., would that prompt maybe more countries to be more amenable to cryptocurrencies, you think?
Well, from our perspective, over the last 3 years, we have been engaging with many regulators in different jurisdictions, and a lot of the jurisdictions are showing very positive point of view toward Bitcoin and toward crypto. U.S. has been one of the jurisdictions that has been having a lot more uncertainty, if you will, compared to other jurisdictions. And as we are seeing, things are clearing out, hopefully in 2025. And I also think that will, as to your point, will have a ripple effect, hopefully positive ripple effect in other jurisdictions, and helping us to see more and more clarity from a regulation perspective, which we absolutely embrace as part of the industry.
But the issue for the industry is the convergence of the regulations. We know that crypto players have complained about how they've had to navigate different regulations. When might we see that convergence? And might the U.S. now play a bigger role in dictating that, simply because under Trump, it wants to be the Bitcoin or crypto hub of the world? Yeah,
my personal point of view is that I think there are major issues such as consumer protection, such as segregating customer assets from corporate assets. Some of those key such as AML policy, for example, there will be fundamental similarities among different jurisdictions because the fundamental principles are the same. However, different jurisdictions do have their own subtlety when it comes to their own economic system, their own financial system, their own culture. So I think that different jurisdictions will continue to have their own specific differences, just like what we have been seeing in traditional financial sector, right? When it comes to banking requirements, trust, payment, the regulations in US, in Europe, in Asia, in different parts of Asia, are all different. There are differences. So I think there will still be regional differences. However, I think a common theme is that there will be more and more clarity when it comes to regulation. There will be a clear legitimacy, regulatory legitimacy around the regulation, around this industry, which is a huge positive to both capital as well as talent flow.
Hong, can we talk about legitimacy when there is a conflict of interest? This is a president who loves and is invested in cryptocurrencies. Can we talk about legitimacy in regulation?
Regulation is not going to be driven by the president himself, right? Whether, whichever president, it's really the tone that it's set on from the top. And legislation, at least in US, president is not the legislative body, but it does set the tone, and the administration that he picks will set the tone from the top. But I think any legislation that we are going to expect in the market has to pass, the legislative body in US, which I think there is actually already a lot of momentum that is going in the right direction in the United States.
Hong, let's talk about projections for the various coins. Earlier, you talked about how you see Bitcoin getting to 100,000 next year. How about the other coins like Ethereum, like Dogecoin? We know that Elon Musk has weighed in. He talked about how he sees Dogecoin at $10. I mean, what are some of your other projections?
I am, as you can see, I'm not really good at predictions. I predicted that for Bitcoin price 4 years ago, and I have to wait for 4 years for it to come true. The other thing is that I think from a historical perspective, if we really try to tell from past experience, generally speaking, for every cycle, Bitcoin goes first, and then you see altcoins, and then there's generally a kind of cascading effect because of how capital flows. And I think that probably going to still hold true for this cycle. Ultimately, I think it really comes down to everyone doing their own research, and they have to pick their own comfort zone for price. A key advice, if I can, to provide to anyone watching this is be really careful and only put in what you can offer to lose. That holds for every investment that you hold. It's really about the error of margin. Do your research, but also having an error of margin. So there is a level of safety, and you do that responsibly. So that would be the biggest piece of advice I would give in this scenario.
People talk about how it is a sweet spot for cryptocurrencies right now. We have the Fed cutting rates. We have China slowing down. We have Trump in place. He is supportive of cryptocurrencies. But what do you deem as the biggest risk for this asset class?
I think in general, it's always going to be a volatile asset class. So I think people should always bear that in mind. Secondly, it is going to continue to be affected by macroeconomics, macro data. We all say that you buy the news and sell the reality. I think between now and the time when the new administration, Trump administration, is sworn in, I think there's still some room to grow after the new administration comes in, it really depends on what the policies, what specific policies will be made, both within crypto industry as well as outside crypto industry. I think that will also have a huge impact on where the price would go. And then ultimately, I think it's really about within the industry, like what are the innovations, new applications that will come along that actually have a real impact on people's life and that actually has real use cases. So I think those would actually form the foundation for price momentum, both in the short and long term.
Caution, still the word. Expect volatility. Hong, thank you so much for your insights today. Hong Fang, president at OKX. Still to come, L'Oreal says the beauty market is poised for continued growth and innovation. The president of their South Asia Pacific, Middle East and North Africa unit will be joining us for more insights next. Keep it here with us. This is Bloomberg. Welcome back. India's been trading for about 3 minutes and it is joining the sell-off in the region. The Sensex currently down about 0.5%. Remember that we've seen that sell-off for quite some time now. People talk about how money is being taken out of India and being put into China. In terms of the Nifty Bank Index, currently down by 0.4%, pretty much a down day for benchmarks in India. And in terms of the Indian rupee, stable versus the USD at 84.3862. Of course, we have a Bloomberg scoop today talking about how India is ready to weaken its currency in line with the yuan, and that's on the back of the Trump win. Of course, remember that when it comes to those tariffs, there may be implications on imports and exports. The RBI will use its reserve to keep any fall in check. Now, whether it's China's attempts to address its economic slowdown or the potential threat of Trump tariffs on inflation, at the heart of the conversation are consumers. With so much riding on consumer confidence, where do the risks and opportunities lie? Let's bring in my next guest here in the studio, Vismay Sharma, President for South Asia Pacific at MENA at L'Oreal. Vismay, thanks so much for joining us. I mean, when we talk about consumption, we're seeing consumption weaken, not just in China, but also in India. What's happening on the ground?
So firstly, thank you very much for having me, Haslinda. As far as our business and our industry is concerned, the region that I look after, which is South Asia, Pacific, Middle East and North Africa, the beauty markets in this region continue to be very dynamic. We still see a double-digit growth. We don't see any slowdown in any of the markets, including India. And that's very, very understandable if you think that this part of the world is 40% of the world's population and less than 10% of the beauty market. The opportunity is great. And this great opportunity is built on the emerging middle class, which we see in India, Indonesia, Saudi Arabia. We see consumers who are much more connected, much more aware. So when you put all the elements together, we see and we are very, very, very optimistic actually about this part of the world. And there's no slowdown at this point.
Is it about the price point? How are you looking at price points, given the fact that we're seeing a slowdown generally across the board in these economies too?
So in terms of the price points across the categories, and this is a trend that we have seen since the pandemic, we find that there's premiumization. If you look at skincare, if you look at hair care, if you look at fragrances, all the key categories that we operate in, we see a premiumization. And that premiumization largely comes from the fact that consumers are much more aware of high quality products. They are aware of innovation. They are aware of new molecules. So if you go back 5 or 7 years, when you look at Google search trends of that time, these trends were much more around ingredients, natural ingredients, etc. Today, these are much more around molecules. So people talk about hyaluronic acid, they talk about retinol, when they used to talk about rose water or sandalwood at one point in time. So we clearly see a very strong shift towards innovation. We see a strong shift towards science. And when that happens, L'Oreal tends to win. And
when we take a look at your stock, though, I mean, they haven't done well. In fact, they're down about 20% on the year. And that's on the back of the dent in the Chinese market. Can the markets that you're looking after, like South Asia, like MENA, can they counter that slowdown? You talk about double-digit growth, but is that enough?
Well, firstly, we have to admit that this part of the world is still relatively lighter in terms of its weight as far as beauty is concerned, beauty market, and that's the case with L'Oreal as well. The key thing is we look at business over a long period of time. We are a company that's been in business for 115 years. So obviously 1 quarter or 2 quarters is not what we look at. We look at the long-term trajectory, and long-term, this part of the world will become much more significant. It continues to be on that path.
What is significant? 20, 30%?
Yeah, it would.
What are you looking at?
I mean, eventually demographics win, right? So when you have big population, when you have affluent people and affluence rising, economies that are resilient. If you look at the economies in this region, India, Indonesia, Vietnam, Saudi Arabia, all of these are very buoyant economies. And eventually, if you have the population, if you have young people, working class, and growing economies, finally demographics will win. And that's what we are banking on.
How are you then positioning for your growth in this part of the world? We've seen how, there's great competition for local brands. If you take a look at India, for instance, lots of local brands winning hearts and minds. How are you countering that?
So there are 2 parts. The first thing is that eventually consumers, it's not about local brands, it's about relevant brands. It's about bringing right solutions when it comes to their skincare, when it comes to their hair care. And L'Oreal is better positioned than anybody else.
How so?
Well, we are a company that's based on science. It was founded by a scientist. Today, L'Oreal employs over 4,000 scientists. We invest over 1.2 billion euro in research and innovation. And we filed, for instance, last year, we filed 610 patents in beauty and beauty space. We have our own labs in India that are doing research on consumer products, on hair, on skin. Today, L'Oreal has by far the richest database, richest knowledge base in terms of human hair, human skin. And that puts us in a very good position when it comes to creating relevant products for the consumers. Next to that is the marketing machine of L'Oreal, which is able to create relevance with the consumers in terms of content, etc. And the consequence of that is we continue to win. If you look at the long-term trajectory, there are very, very few companies that have been at the #1 position for such a long period of time. And L'Oreal is. And if you look at all the countries, if you look at my region per se, we are significantly outperforming the market. We have been doing it for a long time, and we've been gaining shares, and we continue to do that.
As you talk about innovation and growth, does it make sense for you to be looking at M&As? There are lots of startups out there which are innovating in your space. Does it make sense? And are you looking at perhaps M&As within the next 12, 24 months?
Well, we keep looking at M&As all the time. There are lots and lots of interesting companies that come about.
You're in conversations then?
We are always in conversations. In every market, we keep looking at all the interesting companies. And these companies could be in the product space. They could be in consumer experience space. If you see some of the recent acquisitions that we've made in the tech space, or mergers and acquisitions, or collaborations that we've had with startups, they are really, really interesting. I can give you a few examples. If you see Modiface, which is a Canadian company, which was a world leader in augmented reality, virtual reality. We acquired that company, and today we are using virtual try-on on our websites. We are doing it on our partner websites. So as a consumer, you can go on Shopee, for instance, in Singapore, and you can try a makeup of L'Oreal, of Maybelline, for instance, before you buy the product. And these kind of things are great for us. So we keep doing that all the time.
Vismay, we have to leave it there. Thank you for joining us today.
Thank you very much.
Vismay Sharma, President, South Asia, Pacific, Middle East, and North Africa at L'Oreal. Let's take a look at how Asian benchmarks are doing under pressure as we take a look at how the MSCI Asia Pac Index is extending its decline today to about 1.2%. The Hang Seng also in negative territory. Bear in mind that we're expecting those tariffs to weigh on Chinese stocks in particular. Already we saw the Nikkei 225 also in negative territory, down 0.2%. The dollar remains resilient, currently extending its gains up about 0.1%. Well, before we go, here's a look at our guest for tomorrow. We'll get insights on the banking sector with a global CIO of Bank of Singapore. Plus, we'll talk about the growth strategy of Indian conglomerate RPSG Group in an exclusive interview with their chairperson, Sanjeev Gonka. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.